Hello, everyone, and welcome back to another episode. Today, I'm very pleased to have Varun Jhaveri, Managing Partner at Evernile Capital, an investment banking and data sciences group based out of India. Varun brings a very interesting combination of investment banking, capital markets, healthcare, financial structuring, and public sector expertise and experience. Before Evernile Capital, he was working at the Asia Development Bank and the National Health Authority of the government. So he has experience from the government sector to investment banking, capital markets, and whatnot. My first question would be, what drove you into this particular sector? What were some of the early on experiences that shaped your perspective and drove you into investment banking?
Hey, hi, thanks, Aryan, for having me. It's a pleasure to see someone as young as you, doing this podcast and being so interested in capital markets, investment banking. So yeah, thank you for having me here. Excited, to chat with you. So investment banking, it's a very interesting, sector, career, profession. My journey with financing and investments, it's been more than a decade, since the time I've been involved. Started off as a management consultant, worked with organization, very large scale organization, companies, government entities, saw companies and organization operating
Yeah.
from the very core, saw different facets, how they grow, how they are managed, help in building several strategy pieces. Over a bit of time, also saw how capital is a sort of a critical lever for growth, expansion, structuring, and overall, the first and the most important objective, which is really creating value for the shareholders, for the society at large, right? So saw a lot of those things firsthand. As you said, was with the Asian Development Bank, was involved, in healthcare financing investments. We used to have a very large scale healthcare fund, so was involved in building that. It's a healthcare facility. So saw firsthand how capital can really help organizations, shape their identity. Went to IIM Ahmedabad, did my MBA, and then the idea when we started Evernile Capital was really that how can we firsthand help organizations create or rather maximize the value using capital. So the approach was not only to do deals or transactions. Of course, that's a big part of what we do, but really look at a very holistic part that how can we help organizations drive value, and being someone that they can rely on for all different sort of capital and their financial structuring needs. So that is how Evernine Capital really started. Me along with my another batchmate from Ahmedabad. I largely come from healthcare and pharma sort of a background. He comes from the consumer side of things. So that is when we joined forces and we started Evernine Capital. Now it's been 3 years, and we've been able to fortunately be involved with a lot of interesting organizations, clients that we are very grateful for. They have really trusted us with some of the very interesting work. So yeah, every day is very exciting, very adventurous, and contrary to the popular belief, we absolutely enjoy and love doing what we do, that is investment banking. So yeah, so that's been the journey. Very thankful for that.
Sounds pretty interesting. Wanted to know, so what were some early lessons that you learned during the earlier phases of your journey while starting Evernal Capital? Starting an investment bank is very difficult, and even starting an investment bank at a young age is more difficult. So what were some obstacles that you faced during the earlier periods, and how did you overcome those obstacles?
So it's in terms of the obstacles and starting an IB firm, of course, it's a mountain to climb because you have a lot of good investment banking firms within the market, within the region, who have been there for like almost like 5 decades. There are also some which have been there more than like more than a century, right? So of course, the first thing that you need to focus is that how do you really build your confidence and credibility with the clients that are trusting you with some particular work. Second is, of course, how do you really hire the best talent out there? And the third is that how can you really structure out transactions and just ensure that you execute and complete the transactions, right? So there are of course a lot of obstacles, but I think the three lessons, and this is even before Evernile came into existence, I think three things that I personally hold very dear to me, and that has also set up the overall sort of the value system and the culture that we practice at Evernile Capital. So one of them is excellence. I think one thing that really defines our work and one thing that we really strive for is how to have excellent quality of work delivered. So everything that goes, out from the organization, all of us have to put our own individual personal quality of excellence stamp on that. That is the best that I could have or I can deliver. The second is, ambition. We are all, a bunch of ambitious folks who wants the organizations, us as well as the client to do ambitious things in their particular journey. So, that is the second big value that, how do you really think on a much more ambitious scale than, what you would do on a normal sort of a day-to-day affairs. And the third is consistency. So, along with ambition, we want to do this thing every single day. So it should not be like a one-off thing that you're producing excellent quality of work like once in 3 months. That is not what we do. The idea is to do best quality of work every single day of the year, and be ambitious about the work. I think these three are the core values and the core lessons that I think all of us we hold very dear to ourselves. We take pride in the work we do, and that also brings a lot of accountability. So yeah, so that is those are the things that we have held very dear to us, and that is the one that has really helped us grow significantly over the last few years. So that's been some of the lessons.
Sure, sure. I think those are some very important things if you want to achieve anything in any aspect of life or any endeavor. So, for a successful capital raise and in order to execute a deal or close a deal, what are some things that you require? Like, what does a successful capital raise look like? And can you share a bit about any successful deal closure?
Yeah, a lot of them, right? So
Yeah.
I don't want to get into a particular deal per se, but if you look at any successful transaction, right, it has several common components, whether it's a capital raise or a M&A, whatever it is. I think the first is ensuring that there is information symmetry and alignment between the company and the banker and the investor or buyer or a seller who is coming in, right? You just want everyone to have a right set of expectation. So a lot of times when we start off a deal, the company might have, let's say, a valuation which is beyond what the market is providing. So it is our responsibility really to rationalize that particular expectation, and similarly when we reach out to, let's say, some of the funds or prospective buyer or a seller, the idea is to set up the expectation which is rational enough, because it is very difficult to bridge something which are at two extremes, right? So one is being very truthful about the expectation and really aligning the expectation within all the parties. Second is really following the process. A lot of times organizations, they do come up with requests that can we do this within 2 months. which is not possible for most other situations, right? Because there is a process which will involve things like reaching out to the different investors so that they understand. Because for an organization, the business might be very simple because they might be doing it for 20 years, but for an investor who needs to invest, they would want to understand the business in its details, right? So that is really time taking, and there's due diligence, there is negotiation, there are agreements. So you really need to follow the process. There is no exception to the process. You have to follow it, right? So I think that is the second bit part, that you really need to follow the process. Third is being very truthful about what is really happening and what do you really want the capital for. I think the idea is that we want to display the right set of information. We don't want any surprises to come in the process, and that can only happen when every particular disclosures, every material is disclosed at the right point in time. So I think that is the third big thing. So alignment, process, and the right set of truthful information. I think it really helps across the deals, and these are just some of the common ingredients. I don't want to get into a lot of technicalities, but these are the three broader contours that happens. And see, every deal eventually it all boils down to building trust. So everything that I told you, right, these are all components of trusting each other. If
Right.
you do not follow the process, if you try to be hasty, the other person is probably going to have a doubt, and it will take a hit on the trust. So we need to build that trust factor, and that is one important thing, that the bankers who are involved in the process, they need to ensure that there is appropriate and adequate trust that is being built across all the shareholders. So that is something that what we have observed in the overall process.
So, at a particular point of time, you mentioned that you have to be realistic with the timeline. So,
Yeah.
if a client comes to you and they have an urgency for the close, be it a debt situation, be it hurry to grow or expand. So how do you tackle with such kind of situation where you have to manage the relationship with the client, and you have to keep their expectations grounded while working with a client. Let's say someone asks you that they want to close the mandate within a month or 2 months, whereas the amount is just too big and a lot of structuring is needed. So how do you manage such kind of situation?
See, we take pride in being bankers who actually do work at a expedited speed, but we do not miss any step in the process, because we know that anything that you miss or ignore at the starting is gonna be a big deterrent to the overall transaction towards the closure. So that is not what we do. So in such edge cases, and there are many of them, right, which actually come with that expectation. But just like how every process works across the organization, it is not something that uh, an investment bank like us have to park the funds. It is the investor which needs to park the fund. Even an investor, because they are also the fund managers, right? So they also have LPs, they also have fiduciary duties, they also have the duty to do due diligence, right? So in almost all the majority of the situation, it is very difficult to really give a sort of a timeline which is as compressed as like a 1 month or a 2 month per se, unless there are special situations wherein some investor has already been aligned and it's all about just closing and negotiating the terms, or there is an existing relationship that is already there. So we have also encountered deals in our journey wherein the deal did not happen at the first go, and then there was a stalemate for 6 months. The investor, he spent like 7 8 months, but the deal didn't happen. So then we spent 6 months, and then again, the organization came to us and he said that we are okay with the terms. So in that case, a lot of background work was already done. right? The investor already knew the promoters, there was a relationship, they knew what part of business it is, they knew the challenges, they knew the opportunity. So in that case, then, we just pick it up, from where we have left, right? So in those cases, things are possible. But if you are trying with a new mandate and giving a realistic timeline, of 2 months, it is not going to be possible, and rather it might create more harm, because then, just to expedite the process, you might want to cut the corners, and cutting the corners won't help any organization or any fund in the longer run. So we try to be very realistic. We work on expedited timelines, but then we don't miss out on any step in the process.
So, being an investment banker, you work with a lot of companies, and you know what kind of deals close and what kind of deals don't close. So, based on the investor psychology, as well as their needs and investor expectations, what makes a company truly investable?
Yeah, that's a good question. So, see, there are a lot of variables which are associated with it. I can help you list out a few. There is no one set of parameters that if your parameters are above this particular range, then there would definitely be some particular investment. It's a mix of a lot
Yeah.
of factor, right? And everyone evaluates an investment opportunity differently based on their risk and return profile. So before I get into how do we evaluate it, let me just double down on what I mean by risk and return. So for an investment fund, which is like, let's say, an impact sort of a fund, whose expected IRR happens to be like a 14-15%. For them, they want to probably take less risk, because they are okay with a much more moderate return, right? So they would want a lot more from the organization, or a very solid sort of an impact focused perspective in the organization, as compared to a fund which is like looking at a 25%. You have all sets of funds, right? You have early stage venture funds which would be aiming at like a 25% IRR. You have private equity fund which would be doing like a 20-22% sort of an IRR. So you have all different types of funds with different risk, different profile, different ticket sizes. Some guys who come in very early, like an early stage, they will put in like a 2 million. So they will probably be also happy to come at pre-revenue, so the amount of due diligence will be much lesser. You also have funds whose minimum ticket size is like a 40 million or a 50 million. Like I was talking to a fund which is a special situation fund. Their minimum ticket size is like a 50 million. They start at 500 crore. So the amount of their expectation in terms of the opportunity is very different. So they would want a very mature sort of a company, proven business model, understanding how exactly is the cash every single rupee is going to be used for, right? So it really depends on what profile of investors are we looking at. But largely, few factors coming to the investability. I keep saying it's a blend of both art and science, and there is no one who can really say that, "Acha, this is investable and these guys will do it." It's very difficult to really say that at the first shot itself. But few things that we really look at. So the first is, of course, what exactly is the business, and how clear it is for anyone to understand. There are a lot of businesses which are very complicated. They are very regulatory heavy. So you need a regulator to give an approval, with any particular decision, like an insurance business, right? So for an insurance business, every action that they do, it is subjected to a regulator's approval or a consent, right? So then the risk profile of that is very high. So then you have only few investors who will be able to come in for that, right? So one is we try to understand what is a business, and what is the business model. How do you really earn revenue to that, right? What is the scalability that is associated? So a tech business scalability is very different from, let's say, a sort of a capital heavy infrastructure business, like building hotel chains or hospital chains. So it's very different, right? Then we look at what are the type of margins. So business models, what is the type of scalability, what are the types of margin structures. So again, you have some businesses which will have EBITDA of like 10%, You have some which have EBITDA of 30%. So, what does that particular sort of profile really look like, and who would want to come at that, right? So you have businesses which would have done like 1,000 crore revenue, but their EBITDA is only 10%, and you would have businesses which would have done 50 crore revenue, but their EBITDA is 35%. So, again, both of them, their investor profile will differ significantly, right? Then the fourth is that
Right.
you look at what are the market trends. Do we have headwinds or do we have tailwinds, right? So in India right now, if you look at defense, space, healthcare, pharma, there is a lot of sectoral support. There is a sectoral bullishness, towards that. But then there are also sectors like, let's say, crypto, which is in a very gray area with regard to government's regulations. So it's very difficult for a crypto business right now to get a private funding, because the investor themselves were very confused about what exactly will be the regulation that the government will really come out with. So market trends, right? Then the market opportunity, how big is the market? What is the market share of that? If the model is great but the market is too niche, then there is going to be a ceiling. So eventually, investment is about a very single sort of a principle, that if I invest X, how am I gonna get like a 3x or a 4x within y number of years, right? It is as simple as that. So if the market opportunity itself is, what type of market opportunity really exists, is it mediocre, is it very sizable market? So that is the other thing. Then we look at what is the promoter's profile. What has promoter really done, what is the background, how involved are they? Businesses with promoters, and this is a common theme that we see, if they are doing multiple businesses, it's very difficult for them to get investment, because an investor wants to invest their particular funds in a business where the promoter is fully focused. You don't want one promoter to be running like five businesses, right? Then you look at the corporate governance practices. What is the type of data reporting standards? How are financials calculated? How is the accounting? What are the good practices? All those things, right? So those are some of the things that we look at it. Of course, as a bank, there are a lot of factors. Like if I have to list out, there are more than 50, factors that we really evaluate a particular opportunity on. But these are, some of the things that we typically see in a business, and then we, of course, benchmark them with some of the other competitors in a similar space. So, I'm not going to compare like a packaging manufacturing industry with a sort of a grocery margins, because like a grocery online margins, right? So we try to look where does that company really stand in terms of their peers, and we benchmark them to really understand the sector and how are they doing. So this is how typically we assess the investability potential of any particular opportunity that comes to us.
Sure. So, you've done a lot of deals, and there must be some deals that you couldn't close.
Yeah.
So, and there's a saying that failures teach you more than success ever can. So, what are some lessons that you've learned across various mandates and transactions? What are some biggest deal breakers and red flags for investors? Like, was there any deal that you were on it, you were working hard on it, you spent a lot of time, energy, and opportunity cost into it, and it was like, you spent a lot of time into it, you came really far, and then due to like a small reason, or like something that you didn't even expect, came out of nowhere, and the deal was finished, like it couldn't close. Was there any situation like that? Are there any particular deal breakers that bankers and capital advisors need to be aware of?
uh See, every particular banker would always have, such sort of deal scars where, a deal was very close, to getting executed, but then there are always some variables, that comes in between and hinders, the closing of it. One is the way we see transactions, Aryan, is that for us, we always prioritize relationships over, closing a deal, and for us, we never really say that if a deal is not closed right now, it would not happen, like a year down the line or 2 years. For us, it is, it's a relationship driven for business, right? So, uh, but if I have to, probably pick a couple of themes, and I can tell you from some of the personal experiences. So one is the way the overall your cap structure is present, right? So one of the deal that we're doing, very, it's a massive deal, but at the end, the secondary shareholders were not, ready to sell their particular shareholding, and the entity was present in US, and the fund was present in India. So the challenge is that, there are LRS sort of limitations where an Indian Indian operational fund, it's very difficult for them to invest in the US holdco entity. For a large part of time, the promoter was okay shifting the holdco entity, to India to get this particular transaction done. But then the secondary shareholders, which were present in the US holdco, they just did not agree, and because of that, the holdco couldn't shift to India, right? And the deal couldn't go through.
Yep.
So the complicated, both the cap structure and the way the company is really, structured in terms of its, holdco entity and, subsidiaries and all those things. So one is that. Second is, there are going to be a lot of regulatory sort of consents that will be required in regulated businesses, right? So let's say if your deal execution is conducive to you getting some sort of a regulatory approval. Again, it's from a personal experience. Again, a large size deal, wherein the regulatory consent did not really come through, because of which, the funding or the funds or the investment was not, it did not happen at that particular point in time. So there is always a risk with such heavily regulated sort of a sector, right? The third is changing expectations and changing circumstances of both promoters and funds. There are a lot of times when, because for a transaction, it typically takes like, 7 months, 8 months, there are DDs, everything is going to happen, right? So a lot of times a fund's internal mandate, it might change because of changing priorities of LPs and investment committee. So something that they might have been super bullish on, they might, want to refocus on something else. They might just get some another opportunity, or they might want to move towards some different sector because of evolving market trends, right? Again, I can all these things that I'm telling you is from, the actual experiences, right? And similarly, it happens even with promoters. They might be engaged in a conversation up till, very end, but they might find some other opportunity which might make much more business sense to them, and probably it might meet the the quantum of investment that they might require. So one of the business, wherein a private equity was going to step in, everything was pretty much clear, but then the promoter got the opportunity with one of a very large corporate venture arm of a very large company in the same sector, to come and invest in them, and over a period of time acquire them. So that was, more appealing to the promoter. So of course, preferences and priorities change, because it's a longer process. As I said, 7-8 months it takes. So these are some of the things, and that's why as a banker you need to constantly keep yourself informed about the circumstances and the alignment, because you don't want any surprises, right? So as soon as you get an idea that something like this is happening, your responsibility is to inform the other side, so that it does not end up as a surprise which can cause some sort of a sourness in the relationship. So that is, it's a very slippery slope for a banker. A banker is, always in such situations. But I guess that is how the job and the role of a banker is.
True, true. So, initially, while building out Evernile Capital, how did you acquire your first few, retainer clients? Because early on, of course, you had an IIM MBA, which would, add on your credibility, and you had a robust team and, partners. So, For someone starting out, at a young age or something like that, how does one, acquire their first few retainer clients?
Yeah.
Yeah.
So I think for us, investment banking is not only about transactions. I keep saying the same thing
Yeah.
to the team and to the clients also, right? It's like a permanent relationship that you are going to have for a very long time, and our focus is on how to really create value for the client. And it can be in all, sort of things, right? Like, can you help facilitate a business partnership? Can you help anchoring like a JV? Can you connect folks who can help the client with expanding the business? Can you connect the client with someone in the international markets for helping them with some sort of an exports? Can you connect with folks who will help them optimizing their operations and improve their margin profile? So for us, transaction is, of course, it's a core part of what we do. But for us, our relationship with clients is way beyond transaction. That is how we see investment banking, and that is also what really makes us very excited about the job, because a transaction for any particular company will happen like once in 3 years or once in 4 years. But our relationship with client it's like it's like a weekly affair, right? Where we try to see how can we keep on continuously adding value to the work that they are doing. And I think even for getting some of the clients, because of course we all come with some sort of an experience, some sort of a network, connects in the industry. We know a lot of folks. We have a very large alum community. So I think we have been very bullish one on India, and the very strong mid-market businesses, promoter-led businesses, family-led businesses. And we feel that in the next 2 decades, these businesses are going to be massive industrial houses. So a company which is right now doing like a 100 crore, 150 crore, 200 crore of revenue, uh, if they expand and if they institutionalize some of the work that they are doing, they are going to be big powerhouses. And that's a core belief of some of the work that we do in the country, right? So I think for us, really helping clients picture that out, that how can you create value creation through capital, through better financial allocation, through better financing practices. I think that is a type of association that we really start with. So we typically don't really start with that, hey, can we do like a fundraise, right? Because that is a part of what we are trying to do. Can we do an IPO is like a part of what we are trying to do. It's a journey, right? And we want to be there throughout the journey. So that is what we typically do in terms of our banking practice. And we only get to doing a transaction when we know that the client and the organization is mature enough with regard to the organizational preparedness, because we do not want to do a transaction when the organization itself is not prepared. So and then we have all different sets of way through how we use capital as a lever. So there are a lot of times when we will be just doing like restructuring, and we'll spend quite some time to ensure that the way capital is being used currently in the company, it is attractive enough for them to now go towards the next set of their growth journey. There is enough clarity that what capital you need and why do you need it. Because it's very easy to just say, hey, I need like 20 million, but what if that 20 million is going to do for you, right? And how are you going to spending that, and what is going to be the return on capital? What is the investor going to get out of that? So having that enough clarity within the operators, that is very critical. So we also help in that particular preparedness. So I think that is how we see banking, and that is how we have always been very forthcoming. Even today, we never really tell a client that you need to do a transaction, you need to do start a transaction within like next 1 month, or we are out of it. Rather, we tell them that, hey, here are 10 things, let's work on this, let's prepare ourselves, and then go for this particular set of transaction. So that is the way that we typically work.
Okay. Makes sense. Yeah, I really, I'm aligned with you over that, and I'm very aligned with this kind of approach. So one more thing, I wanted to ask and wanted to focus on is the investor distribution, and how do you go about building those relationships? Because investment banking is rather than finance and the technical aspects, it's eventually it boils down to the relationships, who knows you and who and the network that you have. So how was your journey? How did you build this network? And who do you give credit to for building these kind of relationships with private equity firms, funds, UHNIs, family offices? How do you meaningfully work with them and build relationships with them in a way that it benefits you and benefits them as well?
Yeah, I think the way we do this is by bringing good, relevant opportunities to different funds which are really aligned with what they're looking at. Uh, Understanding their risk profile, the return profile, understanding their previous portcos, how an investment in this portfolio will be complementary to some of the work that they have done, how it fits within their investment criteria. I think that is 50% of work in terms of aligning with the investors, right? You do not want to send irrelevant opportunities, or like bulk opportunity, like a bulk email opportunities to all different types of investors, because all of them, they look at a very different set of things, right? So for any opportunities at any given point in time, at max you will have like a 25, 30 aligned institutional funds. Of course there are a lot of HNIs and family offices. We work with very selective family offices. Our work is largely with the funds. HNIs, we always try to bring them over once we already have a lead investor. So a lot of our work is very structured around the funds per se. So one is that how to really send opportunities which are relevant. The second is the info material and the way we structure our information. What we have heard, from quite a few fronts, is that it is really top notch, and we take pride in that particular work. So we try to present a picture which is very realistic, which does not really give any sort of gray areas, and whatever information that they require, we try to present that. Third is preparing the promoters, because eventually the funds are investing in the promoters. So I think we also prepare the promoters, because the promoters, they already have an understanding of what they want to do, but it is also about just speaking a sort of a language which can be very easily understood by the funds and by the investors. So I think we also prepare them and just help them get that particular clarity. And that is what funds also appreciate, because funds also have limited time. At any point in time, they're evaluating so many mandates, and it is a very small percentage that they actually end up funding. There are a lot of funds which will probably do like one or two deals a year, and they will evaluate like a 500 deals. And I'm talking about like large ticket sizes, right? Like guys who are starting at 15 million. Uh,
Sure, sure.
so you want to ensure that whatever you bring, it is taken up with seriousness. And I think over a period of time you build your credibility, right? So it is not a relationship that is only built by a personal rapport, but more to do with the quality of work. And of course, then it compounds, right? If you have been in the market for a
Sure, sure.
long enough time, people know each other. It's not a very, very, large market. People know each other. People know the type of work that everyone is doing. So I think that is how, trust is built, credibility is built, and that is how, relationship compounds.
Two things here. First of all, you can't have one without the other. Like, if you don't have the deal flow, you can't get the investors, because investors want high quality deals.
Yeah.
But, vice versa, if you don't have an investor network or investor distribution, no company would want you. So, while starting out, it can get really tricky because, once you get into the loop, once you've built either the deal flow or the investor distribution, it becomes like a virtuous cycle. But, how do you, build that? What do you start with? Do you first build the investor distribution, or first do you build the deal flow?
I think you need
Or
to
do
do
you do both
parallelly.
simultaneously?
You have to do both parallelly, right? And that's why the business in the initial stage is a very tricky business. So you need to build both the things parallel. You need to keep understanding what is the type of appetite that a fund is having, what are the investment priorities that they are looking at, and parallelly you also need to keep talking to different promoters, understand what are they doing. It is, as I said, it is not something that will come on day zero, day one. It takes time, because it's a business wherein reputation and credibility compounds. But the idea is to do both parallelly, and not only think about investment banking as a business of only making transactions. If you start thinking about how can you add value, you have a much larger sort of a mandate with regard to the promoters. So an example, so we, at any point in time, we are doing close to around, 10 to 12 different transactions. So one of the early transactions that we were doing with regard to NBFC, so our relationship never really developed because, we were supposed to do a, capital raise for them that eventually happened. But how it really started is, we helped them, get connected with someone who was like a big fintech player and wanted an embedded lending sort of a NBFC to come and do the underwriting and the distribution, right? So that is how we connected them, and that is how they saw, like, the promoter, the NBFC promoter also saw the value, because see, a promoter wants to expand the business, he wants growth in the business. So if you can help with some of those particular things that will add value, I think that is how you can also start off the relationship. And the idea is that once you start, then you keep on developing it and maturing that particular relationship. So if you start thinking beyond transactions when you are starting out, it might be easier for you to figure out how to really add and create value.
True. I totally agree that with that. So, at a practical level, how do you approach these institutional investors and funds?
So as I said, we do quite a few things. One is we are doing, some roundtables with selected funds, which basically aligns with some of our priorities. Second is we send them relevant opportunities. Third is that we keep on doing a lot of update calls to understand how their priorities are evolving, how are their portfolio companies doing, if their particular portfolio companies, because they also eventually need to exit out of it. So what are the transactions that they are looking at. Fourth is we ourselves produce a lot of content. How are we seeing the sector? We also do a lot of thesis on different sectors that we are looking at. So we also produce a lot of content, like a thought leadership thesis. And we also connect a lot of relevant companies which might not be requiring investment, but it would be helpful for their portfolio companies, because eventually an investor is having a portco where he also wants to increase the value of those particular
Yeah.
portfolio companies. So an investor can then become a facilitator, just like us, right, in connecting both the companies and creating value for both of them. So those are also some of the things that we are very actively do.
So, what are some skills that are required beyond the technical skills in investment banking? Do you need to be good at sales? Do you need to be good at, of course, the financial aspects of things? What other skills are required, and also at the same time, what qualifications are needed, or are good to have. Would you recommend something like a CFA, though it is more for money management, but still, what's the ideal educational background for an investment banker?
So for someone who is just starting up, joining the industry as an analyst, the CFA is a good sort of learning platform, and it's a good foundation course wherein they would start understanding how the businesses work, how the capital moves, how to look at numbers, how to assess, analyze them, how to do different modeling, prepare some documents. So it's a good sort of a stepping stone. So CFA is a good course for sure. As you move in your career, an AVP, analyst will become like an AVP, VP, director. So as you move on, it is a lot of things that are a lot of skills that will be required, which would be in form of how do you really develop your own sort of an intuition and judgment over few sectors, right? So what is that? Second is what is the way you really communicate and explain your particular ideas. The third is that how you are really available at different situations and how you troubleshoot a lot of issues that come up. And so it's a mix of a lot of interpersonal relationship, interpersonal skills that come handy. But of course, you need to have a very strong technical base to develop that particular intuition and judgment. Because those interpersonal skills will come in handy when at the back of mind you're very clear with the fundamentals of how business and the investment industry works. So that is something that eventually a person who wants to be in the industry and wants to enjoy the industry needs to develop. See, as a at a partner level, a lot of your work is going to be focused on three things. One is how to get more business. Second is going to be how to oversee the overall quality of delivery that is happening, and the third is that how to keep building the brand and hire the right set of people. But eventually, so eventually these are the components that one needs to develop. But when you are starting out, I think if you start with just understanding how the businesses work at a very fundamental level, I think that is a sort of a strong platform to go forward with. So CFA is a good course, and then MBA really helps. I think MBA in investment banking is very helpful because it helps you develop some of the right set of skills that are required for a lot of stakeholder management and alignment. So I think those are some of the things that one needs to probably think about while just thriving in the industry.
Sure. So, how do you think this coming of AI and the LLMs and a lot of
Yeah.
uh, data centric intelligences into investment banking, how is it shaping the industry over the next decade? And what are the things that are changing, and how are you integrating AI into investment banking to make processes more efficient, more effective, and you can how do you integrate AI to save time into investment banking? And how do you see the future of this industry with the coming of AI?
So AI has been a big disruption, and it is very helpful to use the right form of AI in improving the overall productivity. I think within our institution, we definitely have a lot of our proprietary models because we have our own internal AI team which really builds out a lot of algorithms and a lot of proprietary workflows based on different LLMs, based on some of the derived know-how that we have. But I think as a principle, we are very clear that for us, AI is an assistant to the to all the nice humans that are working along with us. So at the end of the day, the accountability is on the person who is using the AI. So the person can use AI as an assistant, but the final accountability for that particular deliverable or outcome is with the person and not the AI. So as a productivity booster, we have a lot of workflows, and we have really tightened it, and as we move, it will keep on improving the productivity. But at the same time, we know what are some of the guardrails that we want to put in place, whether it's with regard to creating documents, evaluating deals, doing modeling. So everywhere we have some bits and pieces of AI that really helps us. But eventually, as I said in the earlier part, everything that leaves, including the deliverable that goes to client, which basically leaves from a partner's desk, has the accountability stamp of that particular partner. So you can use AI for whatever is required, but eventually the accountability lies on you.
The other thing I wanted to know is that you are into this industry and you've been doing this since the last decade. So, where do you see the biggest gaps in the market, as in private markets and investment banking? And, what could be some of the biggest opportunities of the next decade?
I think one is, as I said, Indian mid market. The promoters. So now there are a lot of businesses with second generation who wants to expand, who wants to formalize their businesses, who wants to go public, who wants to acquire other firms. So I think there is a massive opportunity there. The because of the maturity of the Indian markets, Indian capital markets, and the growing ambition. Every individual wants to grow their firms at a very high sort of a growth rate. A lot of majority of organizations, they are not okay with just modest growth rate. So it's very heartening to actually see, because that has a direct positive impact on the way economy shapes up. So everyone wants aggressive sort of growth to happen at a larger level. So one is that a lot of mid market companies are maturing, and as I said, they're going to become larger corporations in years to come. So I think one is that how do we really help them in this particular sort of a growth journey. So that is a very interesting part. Second is, I would say the Indian R&D scene is also getting maturing. So there is more maturity that is coming there. There are more investors who are ready to take more risk and fund some of the more disruptive companies. We recently saw a lot of companies have come in space tech, defense tech, biotech, companies in biotech which are still doing their preclinical trials, animal trials. They are getting funded. Space tech guys who are still building different prototypes, they are getting funded. So a lot of companies which are really into disruptive innovation, whose model is to really have some sort of an intellectual property and build businesses around that. There are a lot of AI based drug discovery platform, therapy platform in biotech. They are getting funded. So, very, very hopeful, because they are going to create, they are, as I keep saying to my team, they're moonshots of Indian economy. They are going to create disruptive wealth, and they are going to have disruptive impact for the overall society and the economy. Recently, right, this Skyroot guys, they did a very good sort of their particular satellite launch. So we are having so many of such companies coming in. So that is the second big theme that I see. The third is a lot of consolidation activity is going to happen. So we see a lot of larger corporations. Either there is a private equity firm which is anchoring them, or they have gone public. So now they also want to further expand their particular presence. There are a lot of Indian companies which are now starting to buy out a lot of foreign companies in different geographies. A lot of pharma companies like the Sun Pharma, recently bought a large corporation based out of US. So we see a lot of consolidation as well as such type of acquisition opportunities that are going to happen by a larger Indian company. So I think that is the third theme that we are very excited. And the fourth is, of course, a lot of companies will keep going public. India is doing a record-breaking SIP, so there is a lot of inflows in the capital market, and there's always going to be appreciation for good companies, wherein you get good capital appreciation. So a lot of good companies will keep on going, accessing the capital markets, become publicly listed companies. So I think that is a theme that would also be very exciting. So I think this are some of the themes that we are quite excited about, and we see a lot of sort of potential in the country in the coming decades across this particular themes.
So, some of the closing questions. So, as a young professional,
Hmm.
how do you choose between investment banking or capital advisory versus, businesses like private equity, which are more
Hmm.
require more operations and operational background, and how do you choose between the two?
Yeah.
When you look at a perspective where you are the founder of that particular business rather than a professional working in that firm.
See, I tell my team that see, investment banking, venture capital, private equity, you take any of the business, right? Any of the different players in the market, all of them, they might be performing a different outward role, but internally, if you look at it, there is one common theme, that applies to all of them, which is having a very strong understanding of how businesses really work. And
Yep.
to understand that, you need to really understand the nuts and bolts of how businesses are built, operated, managed, scaled. And it is beyond just reading financial statements, right? How do you understand every single component? What are the incentives of employees to work harder? How to optimize the margin? Why is the margin structure like this? How is the working capital really structured? How is depreciation really calculated? What is the way to restructure different sort of debt? Why did company expand in geography X as compared to geography Y? What are the different unit economics associated with different products? Should a company be pursuing a particular merger or not? How to really value a particular company, how to have different shareholders come in at different particular valuation at different point in time and have the most optimum cap structure, how to give ESOP. So there are so many things. It's a business is, understanding business is like a lifelong journey, and it's very fascinating because all businesses are so different and there are new and new businesses keep coming, right? So I would say that one needs to become a very passionate learner of being genuinely interested in understanding how businesses operate. So I think once you need to start with that, and one needs to see that whether you whether you like it or not, and whether you will spend hours and hours reading about businesses, reading about promoters, talking to them, and being okay in assessing and analyzing the businesses. So I think use that should be the stepping stone. And then an investment bank or like a wealth management or a private equity or a venture capital, they're just different outlets, but at the core of it, everyone is trying to just probably answer one particular question, which is how effectively do we understand the operating of this particular business, that we are okay to either put our money in or facilitate a transaction or whatever that is, right? So I think that is the core that a young person needs to really be invested in, that if I can understand the operating of businesses, and if I'm really passionate about doing this for a large part of my career and a large part of my life, then this is a great industry for those young folks.
So, one of the last things I wanted to ask, what advice, would you be giving to a young individual? Because a lot of our audience is, young professionals. What advice would you be giving to them, in order to build a successful career, a successful life, and, just overall live a purposeful and life full of excitement and ambition and adventure, as you mentioned earlier. And how would you
Hmm.
uh, give them an idea and advice into getting into the investment banking profession?
Yeah. See, to be honest, just like all of the bankers, it is not something that when you talk about, some of the very philosophical question with regard to purpose of life, it is very difficult to, give you answer because I'm not in a spot at that. But I can tell you what are some of the things that worked well for me, and that I see some of the young people also doing well, and that can potentially work well, right? So one is just read. or along with that, watch podcast. They should also watch your podcast, from time to time. But I think reading is very important. Read about business, read annual letters, read companies financial statements if you're really if you're really inclined in understanding businesses. Second is just keep reading about the market trends, how the market is shaping up, what are some of the interesting things that are happening. That is the second thing that one should focus. Third is do well academically. Always keep pushing yourself. The reason for that is in the early part of the career, the academic selection plays an important role. I won't say that is the only thing, but as you grow older, probably that effect will tone down a bit, and other experience will take a front seat. But at least in the start, doing well academically would be good. Fourth is always try pushing yourself to understand what is the best that you can do, right? So even if it is like a small whatever error, just be cognizant of that, so that you can really push yourself towards the excellence. And fifth, that I keep telling to all my folks, is please dream very big. You really don't need to contain yourself. Have a super big ambition. It is very important. The reason for that is the world is now very connected. So whatever you dream, there is a very high chance that you will be able to make it, at least very close to it. Because so much globalization, so much technology, so much information parity that has happened. So I feel that ambition is really important. So I want all the young folks to be very ambitious, because this industry thrives on ambition. The entire, not only investment banking, but the overall financial capital markets, it thrives on ambition. It really brings most of the times the best in the people. So I want young people to do that. So read, pursue excellence, do well academically, and be ambitious. I think these are some of the things. These are also some of the values that I spoke earlier, because these are things that I personally hold myself very dear to, and I think they have helped me quite a lot. So I think this is something that young people should do, and this will probably help them at least get interested towards the industry, and probably they can then evaluate if this is something that they want to do for a large part of their lives.
Thanks. I think that was really helpful. It was an absolute pleasure to have you on the show. Got to know a lot of insights, and got to learn a lot. I'm so thankful to you for being on the show, and for the opportunity to have this conversation. And hopefully, the audience has also found this useful, not just informative. Thank you. Hoping for the best. If you want to say anything to the audience, feel free to do so.
No, thank you, Aryan, for having me. Very very wonderful, chatting with you, and I hope some of the viewers who will view this, they will find it interesting. Very happy to give whatever observations that I have observed in my career. Very happy to share that, and I'm very happy to see that you are at this age you are hosting such a interesting podcast or an interesting chat on capital markets. I wish you also very good luck for all your future podcasts, and I wish all the success for your viewers. Thank you again for having me. Such a pleasure, joining you and having.
Thanks a lot. Thanks a lot. Yeah.
Perfect. Sounds good. Thanks, Aryan. Thanks. Bye.